Should credit be available of taxes incurred on the input side by a taxpayer for construction of an immovable property? This is a question that has reared its head again and again in the history of Indian indirect tax laws since the late 90s, as indirect tax authority in India have always been reluctant to allow input credit towards building of an asset or structure which qualify as an immovable property, whatever be the functionality thereof. In its latest iteration, this question came up before the Supreme Court recently, for the first time in fact under GST laws, in the case of Chief Commissioner of GST versus Safari Retreats. Without going into the details of the arguments and counter-arguments in this matter, it is pertinent to highlight the crux. The Supreme Court held that there are two scenarios where input credit will be available to a taxpayer despite the restriction under Section 17(5)(d). One, where the input side GST is incurred by a taxpayer for construction of a structure which qualifies as a plant or machinery for the taxpayer by being integrally connected to that taxpayer's output activity. And two, where the input side GST is incurred by the taxpayer for construction of a structure but not on his own account. Now, what does not on his own account mean? It means it is not for personal use but for providing output service and, more importantly, for usage by the taxpayer as the very means or the basis for provision of the output taxable activity, as opposed to being merely a setting or premises in which the taxpayer is carrying out business. For example, a mall is the very means for providing commercial rental services as opposed to office space. So this is a very crucial takeaway from the judgment. While these legal principles have been articulated in the context of a commercial real estate business, since that was the lead matter before the Supreme Court, they can potentially be applied in a wider sphere too. For example, by concessionaires operating port, airport, or similar projects under a PPP model, or LNG regasification terminals, or even by manufacturing entities who have incurred or plan to incur significant input side capital expenditure and consequent GST thereon. In light of this judgment, taxpayers should consider the following action points. 1. Review all input side expenses where input credit has not been taken in the last financial year on account of Section 17(5)(d) and evaluate if they should take those credits now before the deadline of November 24. 2. Review all proposed capital expenditure line items where input credit has not been factored on account of Section 17(5)(d) and evaluate whether that should be reconsidered, the costing reworked. 3. Take stock of all pending disputes on account of Section 17(5)(d) and evaluate the necessity to file additional submissions arising out of this judgment. And 4. Whether construction contracts which are currently under negotiation, whether they need to be re-evaluated in terms of transaction structure, clauses, keeping in mind the legal principles laid down by this judgment.